Hey, accounting scholars. We are on chapter 8, section 3. Hey, we've talked about the expenditure process as it related to buying stuff from vendors or companies in order to establish and control your inventories and your cost of goods sold accounts. The other place where you buy stuff and make expenditures is in the payroll process, where you pay your employees. So let's talk about the basic flow of information associated with the payroll process. Okay, we start with the employees, and basically, if you're in a manufacturing environment or a retail environment, you guys have some of you have part-time jobs. There will be a method for the employee to record the time he or she has worked on a time card or a other type of system where essentially a time ticket is the term sometimes used is or punch card is used to determine exactly how much time an individual employee has worked. So there's a recording of time. Then the people that kind of track this stuff are normally considered the timekeeping area. They'll look at the time cards. They'll look at the fact that you have punched in or punched out or logged in or logged out for your particular shift, and they'll compare that information, the time cards, to the time tickets. Then that information goes to payroll, right? And payroll records that information, takes out any deductions that may occur, taxes, any voluntary deductions you may have, and then they let accounts payable know. Hey, okay, we've got to cut a check for this particular individual, and then the accounts payable lets the person who's in charge of cash, it's again here sometimes called the cashier, and that person pays the employee. So that's pretty much the process. You basically log in your hours, each day. Timekeeping basically compares that information, and then that goes to payroll, where they take care of all the recording of time and deductions, and then it goes to accounts payable, and then on to the cashier. Okay, so kind of similar to what we were talking about in an inventory when we had gross and net. Well, in terms of pay, we have gross and net. And from an employer's point of view, here again, if you own the company, your take on this is going to be different than the employee. But from an employer's point of view, when you own the company, gross pay basically means the salary and wage expense that is incurred in an attempt to generate revenue, right? So if you have somebody, you've worked at Target, for instance, they hire you and they pay you X amount per hour. That's the cost that the employer pays. Target pays you to generate revenue. The net pay from the employer's standpoint is the actual cash outflow that goes to employees. So here again, you guys that have had part-time jobs, you may be paid $10 an hour from a gross pay standpoint, but your net pay might be something like $8 an hour because the employer takes taxes out and things of that nature. So that's the net pay that actually goes to you. Withholdings are just that. So if you say to your employer, you know what, you offer a medical plan, I would like you to withhold X amount of dollars to pay to my medical insurance company, then the employer is going to withhold that money and keep it until that payment needs to be made. But from an employer's standpoint, when he withholds the money you earned, it's really a liability to that particular company until that money is paid. Okay, so getting into more detail here in terms of the difference between salary and wage expense and payroll tax expense. What are the differences? Because you're going to hear these terms over and over again: salary wage expense versus payroll tax expense. Well, specifically, salary wage expense is the expense incurred from using employees in an attempt to generate revenue. And here again, you have a part-time job at Target, you have a part-time job at Wendy's, you have a part-time job at Portillo's. The owners of those particular companies are incurring expense, salary wage expense, by using you as an employee in an attempt to generate revenue. The flip side of this, payroll tax expense, and it's important that you understand these differences now, is the expense incurred that the employer has to pay to the government. And these could be state taxes, these could be federal taxes, these could be matching FICA and unemployment taxes. These are what are called payroll tax expenses. And typically they are specifically FICA and unemployment taxes. So here again, please understand how these types of what the definitions of these types of expenses are, and how the expenses are incurred. Okay, let's look at some examples of when expenses are recognized. So, if an expense, when it is incurred, regardless of when the cash is paid, assume a December 31st year for the examples that follow. So in this particular case, we're going to look at some scenarios. Example number one, there's a utility bill received in December. The bill is paid in January. In an accrual system, when would the expense be recognized? Think about it for a second. That would be December. In example number two, you pay insurance for 6 months in November. You recognize 2 months of insurance expense and in this particular case, it would be the year end. So that would be in December. And example number three, you pay the local newspaper in December for an ad to be run in December. When would you recognize that expense? That would be in December. So here again, in each of these examples, receiving a utility bill in December and paying the bill in January, the expense would be recognized in December, even though you paid it in January. In the second case, you paid for insurance for 6 months in November, but you actually recognize the expense, 2 months of that, in December. You pay for a local newspaper ad in December that is actually run in December, and again, that expense would be recognized in December. All right, guys, we'll have some more questions on this tomorrow for a quiz, so please make sure you understand how these expenses would occur and when, and we will see you tomorrow.